Hi, everyone. Welcome to our June 2023 Money Matters webinar. We have a great webinar planned for today. And for those who are joining us for the first time, Money Matters is a ongoing virtual series where we are joined with experts in the field to talk about financial topics that are important to you. We've covered credit scores, disaster preparedness, budgeting, but today we're going to be talking about inflation and the economy with an amazing representative from the Federal Reserve, Leslie Mace. And so I'm glad that you all are able to join us today to learn more. The Money Matters series is a collaboration between the United Way Suncoast and the University of South Florida Gus A. Stavros Center. Today, however, we're going to be joined by, as I mentioned, Leslie Mace. She is the Outreach Senior Advisor at the Federal Reserve Bank of Atlanta. A native of Alabama, Leslie holds her BA in economics and foreign language and an MS in economics. She joined the Federal Reserve in 2010 in the Atlanta branch and transferred to the Birmingham branch in 2022, where she provides programming and resources to teachers across Alabama and the Florida Panhandle. She has taught economics and business classes at Auburn University and Florida State College, Jacksonville, and Daytona State College. Thank you for joining us today, Leslie.
Thank you, Matthew. I'm glad to be here.
Perfect. So as you present your information today, we're going to have, as I mentioned, Leslie's going to have a great presentation. If anyone from the audience has questions on anything they would like to see or hear from Leslie, please use the Q&A feature in the chat. I'll be able to take questions for Leslie throughout the presentation. And then we'll also have a Q&A at the very end if we don't get to your question in time while she's presenting. So Leslie, the floor is yours, and I'd love to hear more about inflation and the economy.
Thank you. All right, so we're going to get started. And before we get started, as Matthew said, I'm at the Birmingham branch, and that's my contact information there. I just relocated after 12 and a half years in Jacksonville, Florida. And that's where I have my connection with the Stavros Center. And there, through that connection, the connection to United Way Suncoast. And so before we get started, I have to give this standard disclaimer that the views are those of the presenter. They do not necessarily reflect the views of the Federal Reserve Bank of Atlanta or the Federal Reserve System. In fact, I always say the only person who's allowed to officially speak for the Federal Reserve System is Chair Jay Powell. I also want to point out that tomorrow they're going to have the Federal Open Market Committee meeting. Starts tomorrow and runs through Wednesday. So that technically makes us in the time period that's known as blackout. I am not in the research department. I'm in public affairs. So we do have some exception, especially if we're talking about just the basics of inflation and monetary policy. But I cannot speculate on what's going to be happening at the meeting tomorrow. I can tell you that. So I just want to get that out of the way before we get started. Today, we're going to be talking about the basics of inflation, how the cost of goods and services is affected by inflation, interest rates, their impacts on you, and some of the tools that the Federal Reserve uses to reduce inflation risks. And so those are what we're going to be covering today. And we'll start right in kind of talking about the Fed's role. So the Federal Reserve is the central bank of the United States. It does have responsibility for overseeing the nation's monetary system. And so the Federal Reserve was created in 1913 by the Federal Reserve Act, and our role in monetary policy was clarified in the 1970s. And so with amendments to the act. And so we are given objectives. We were created by Congress, and we were given these objectives at the Board of Governors of the Federal Reserve System and the Federal Open Market Committee, which is the policy-making arm of the Federal Reserve that carries out monetary policy, should maintain long-run growth of the monetary and credit aggregates. And what this is commensurate with is the economy's long-run potential to increase production, and then also to effectively promote maximum employment, which basically means everyone who wants a job is able to find one, stable prices, and together with those two, we'll have moderate long-term interest rates. So the dual mandate is what we call that, maximum employment and price stability. Right now, and it's changed over time, but right now we would call maximum employment unemployment rate between 3.5 and 4.5%. Right now, unemployment is 3.7%, so we are within that range. And price stability, which is a target inflation rate that over time averages 2%. Now, at one time that target was strictly 2%. That has been changed, and it is now an average of 2% over time. And so that's the mandate that we're given by Congress to carry out in our monetary policy for the Federal Reserve. And so I want to start off kind of talking about inflation. As Matthew mentioned, I have taught basically the intro to macroeconomics class at several different colleges. And a lot of people are confused exactly what inflation is. And so it's a general upward movement sustained in the price of goods and services in the economy. And what I mean by that is it's a macroeconomic variable. It's not the price of gas going up or the price of food going up, although those feed into our inflation measure, but it's an economy-wide phenomena. It's the price level that is rising, not just the price of one thing or the other. So that would change your cost of living if the price of one good goes up. But inflation, that is economy-wide. And so there's a lot of confusion about that, or at least that's what I found over the years with my students. Inflation is a macro variable, and it's the price level that's rising. And we measure inflation by two different measures. One is the Consumer Price Index, and that is calculated by the Bureau of Labor Statistics, the BLS. And then there's also the Personal Consumption Expenditure Index, which is calculated by the Bureau of Economic Analysis. And that is the one that actually the Federal Reserve uses. And I'll tell you a little bit about how those differ in just a minute. So this is actually from one of our infographics. We have lots of infographics that you can order, and they are free of charge. And this talks about the inflation indices, the Consumer Price Index. And so the Consumer Price Index is going to measure prices paid by urban consumers for a market basket of consumer goods and services. We have a basket of goods that the typical consumer buys, and they'll look at the prices of those on a monthly basis. And one of the things to remember about the CPI is it's only reflecting urban consumers. It uses household surveys, and it does use that fixed basket. And it does tend to run higher than the Personal Consumption Expenditures Index, which is the one that the Fed uses. This looks at the personal consumption expenditure component of GDP. So if you remember your basic econ class, there's 4 components of gross domestic product. There's consumption, which is household spending on goods and services. There's investment. That's inventory. It's also new housing. It's capital expenditures by businesses. There's government spending and net exports. So PCE looks at that C, and the reason that's really important is because that consumption part of GDP, that's 2/3 of the economy. I often say the C equals, it's spending by households on goods and services. And that's what the FOMC, or Federal Open Market Committee, ties that target rate of 2% in average inflation to the PCE index. Some of the differences between the two: the PCE updates more than the CPI, updates more frequently. It's better able to capture substitution effects. So when consumers change to a cheaper good, when the price of something goes up and they substitute, the PCE is able to capture that better. The CPI, of course, one of the differences is only urban consumers, where PCE captures both urban and rural. PCE also captures third-party expenditures on things such as healthcare, such as insurance paying for healthcare, or on the cost of prescription medicines. That's kept. So the healthcare is a larger component of PCE. There's different weights for shelter and energy. So you'll see housing weighted more in the CPI. We say that the PCI kind of has broader coverage because it's updating those weights and covering both urban and rural. Sometimes people say CPI is what households are buying and PCI is what businesses are selling, but both of them are telling the same story. They have a little bit different methodology, but they are going to be telling the same story, and we'll see that in a minute. So here's the CPI inflation, consumer price index, and you can see that it is falling. It's about, and now it's at a rate of around 5% year over year. And this is straight from the Bureau of Labor Statistics. Where I got this graph is a tool that we have, the Federal Reserve Economic Data. This is a free online tool that you can access and make these beautiful, amazing graphs with just a few clicks of your mouse. But we see that it has gone from a high of last summer, averaging around 9%, now down to about 5%. So that's how the Consumer Price Index is measuring it. And then if we look at the PCE, the Fed preferred method of measuring inflation, we're looking at 4.2%. And we're seeing the same trends in general. Another thing that always comes up when we measure inflation is core versus headline. So core is going to take out food and energy. And sometimes people always ask, well, that's what I'm spending all my money on. Why do you take out food and energy? Well, there's a lot of other things that go into the price of food and energy that don't have anything to do with supply and demand, for instance. Supply and demand plays a large role, of course, in any price, but you think of food, either droughts, or you think about, that we heard a lot about price of eggs. And part of that was the avian flu. I just relocated from Florida, where they're having a lot of trouble with citrus greening and having very, declining crop yields in the citrus industry. And that, that's because of a fungus that's affecting the oranges. Same with the price of energy. We know that the war in Ukraine played a role. So there's a lot of other factors that feed into those prices, and that's why they tend to be very volatile. But headline includes both of them. And so the headline rate is what people say will really more accurately reflect what you're actually spending. And so there's the core CPI, a little bit higher than what we just saw, 5.5, and the core PCE 4.6. So just a little bit higher with the core. And I will show you where that's coming from. So this is the CPI, and I did this with 4 clicks of a mouse. I made this a great graph. So this is a great tool, and they update it as the new statistics come in, and you can even create an account, and it will update all of the charts you want. You can set a certain number of charts you want to look at, and it'll automatically update them. And so the blue line is the CPI. That's the headline rate. And then we've got the red is core. So there you can see they're pretty close together as we just looked at. And then the green is food. And so you can see where that's above the average for CPI. Of course, just the price of food is not inflation. That's going to change your cost of living. And then we see energy spike last summer, and now is kind of on a demo. Well, we know supply and demand also has a lot to go into energy, summer driving, that kind of thing. And so I just wanted you to get a look at that. And because of all the different factors that I've been talking about, you look at the CPI and the basket of goods, and that's the typical consumer. Well, who is the typical consumer? So the Atlanta Fed does have a tool where you can go in and make your own individualized CPI or inflation measure, and it looks at a lot of different things. It looks like the gender of people, looks at the size of a household. You have a lot of kids, for instance, of course, you're going to be spending more on food, and looks also at age. If you look at senior citizens, spending more on healthcare. Young people might be spending more on entertainment, income, education, whether you buy versus rent. And so you can go in and actually create your own personalized CPI. They have 144 different market baskets that they make. And so I just wanted to put that tool in there. It's part of some of the data that we have in the inflation project that you can look at that's freely available on our website. And this again just comes from our infographic on price stability. How does inflation affect you? Well, it erodes your purchasing power. We have the goods, and we have, in this example, which is a large example, it takes 88% more money to buy the same basket of goods. And so I think particularly for those of you who are, in the United Way, we know that inflation is going to have a very heavy impact on low and moderate income households. And that's something that we've certainly seen and know, because it erodes your purchasing power, and low and moderate income households often do not have the wiggle room to just pay more for food or housing or expenses that come up. One thing I also wanted to bring up, and I know Matthew's going to ask me a little bit about this. This is an oldie but goodie. Back in the days when I first got the internet and the AOL, but I've kept this because I think it's just so telling. They used to have this personal financial literacy series called You Bet Your Buck. And when I was growing up, because I'm a little bit older, you had $1 million, you were set for life. Well, that's something that you got to think about is inflation. And so this just shows, and I'll just come from one extreme to the other. If you had $1 million and inflation was 3%, which has been, that's not that at some point, some years that's been about the average. And we know now we're running at 5%. After 10 years, the purchasing power of that $1 million at 3% is, now you've already lost a quarter of it. At 5%, you're down to 613,000. And then if you want to go to the very extreme corner where you have 7% over 50 years, the purchasing power of $1 million is $33,948. And that's something to think. And I know, Matthew, I'm not going to tee up all your questions, but this is something to think about, particularly when you're looking at retirement, that inflation erodes purchasing power. And we'll come back to some of our tools with our responsibility for overseeing the nation's monetary system. We'll get a little bit into monetary policy. As I said, I can't really speculate on what's going to happen tomorrow. I can't, talk about some of the policy issues, but I can give a general overview, and that's what I'm going to do. So this again comes from another one of our infographics about monetary policy. So monetary policy is the responsibility of the Federal Open Market Committee. And the Federal Open Market Committee is made up of the 7 members of the Board of Governors, as well as the 12 Federal Reserve Bank presidents. Of those 12 Federal Reserve Bank presidents, 5 have voting privileges. The Federal Reserve Bank of New York always votes, and then the other 11 are on a rotation. For instance, our president in Atlanta is on a rotation with St. Louis and Dallas. Of course, everybody comes to the meeting. They usually come with their chief economist and give an update on what's happening in their neck of the woods, because of course the economy here in the Southeast is much different from the Northwest or out, New York City. And so, of course, they can have meetings that at other times if needed, but they generally meet 8 times a year, about every 6 weeks, and announce any changes to the federal funds rate. And so once that's announced, that's going to first affect your short-term interest rates, then it's going to make its way to the long-term interest rates and other financial conditions, and then that will then see its impact on consumers and investors, and then move into employment and prices. And we'll see when we look at the FOMC statement, that lag as it works its way through the economy is something very important to remember when it comes to Fed policy. And so what we are doing now is, if you're in econ speak, is contractionary monetary policy when we have times of inflation. So the first one listed here is selling government securities. Though, as I'll mention, if you remember your Econ 101, you probably thought about the 3 tools: open market operations, reserve requirements, and the discount rate. Open market operations are no longer the primary tool of monetary policy, and the reserve requirement is now currently 0. So those are not primary tools anymore. We do still use the discount rate, but the main tool is now interest paid on required and excess reserves. So when that range for the federal funds rate, and the federal funds rate is the rate that banks charge each other for loans, usually very short term, such as overnight, the results will be it will lower consumer spending, investment, and the interest rate will rise. Aggregate demand, if you remember that from economics, shifts to the left. But another thing you can say for aggregate demand is just spending. Spending is going to shift to the left or decrease. And then we would see lowering of real GDP and the price level, which is the focus because inflation is the rising price level, and employment, which I'm going to talk about. But if we look at real GDP, Q4 of 2022 was 2.6%, and it has moderated somewhat to 1.3%, although it's still positive. So basically, the best way I could say of what changing the interest rates does is the car analogy. So if the Federal Reserve is increasing interest rates, that puts brakes on the economy. That's how you slow down inflation. Lowering interest rates is like putting a gas pedal to the economy. That's just a simple way to think about it. And what does this really mean for you? So interest rates in the economy tend to follow the direction of the federal funds rate that's set by the Federal Reserve. So that's going to include credit cards. People who are carrying a balance on their credit cards have probably certainly noticed this. The average rate on a credit card right now is around 20%. We're looking at, auto and personal loans are going to have a higher rate. Mortgage rates somewhat, although there's a lot of different factors when it comes to mortgage rates, because especially if you're looking at 30 years, 30-year mortgage, there's a lot of other factors that go in. And student loans are set, the rate for student loans are set by Congress, although they also tend to follow the general direction of interest rates. And so that's something to keep in mind on those interest rates. And I just wanted to show a few examples. So this one is going to start small with taking out an $1,000 loan. And so I think, here's where I'm going to put on kind of my financial literacy educator hat, because, people sometimes will take out a loan, what's the difference? 15, 20%, what is really, that doesn't sound like a lot, 5%. Minimum payment, $30. Well, in this case, just over $1,000 loan, you're looking at paying 40% more and taking 18 months longer to pay off the balance. So that's one thing. But, on the face of it, 5% interest doesn't seem that much. And this is, of course, a small balance. And then we've got a car loan, $25,000 car loan, 3% interest rate. And of course, of course, always with interest rates, not just the direction that the Fed is setting, but also, of course, people's credit scores. But monthly payment $472,507 doesn't seem that much. Doesn't seem like that much, but over the life of the loan, $2,000 more paid for a car. And then we get to the big expense, a house, a home, and this is just a 1.5. I took these rates up, and we've got just 1.5% interest rate. This actually happened to someone in my family where they weren't able to lock in their loan and ended up paying over $20,000 more over the life of the loan because of the change in the interest rate. So this is going to be over $200 more per month that to pay for that home. And so over the life of this loan, that would be an $85,000 difference. And so people don't see that on the face. So that's with the higher interest rates, how they translate to the consumer. And so here is the FOMC policy statement. Of course, another one will be coming out on Wednesday. So currently, unemployment rate is 3.7%. Now that did come up from 3.4%. But one thing I like to point out is when the unemployment rate is rising, that doesn't always mean that more people have lost their job. In fact, in May, the economy added 339,000 jobs. Often what it will reflect is more people coming in seeking jobs, and that will cause, which is a good sign, right? Because people tend to, who have been sitting on the sidelines of the labor market, they tend to come in when they think that they have a reasonable expectation that they can find a job. So that it can actually be a positive sign, still in the maximum employment rate, of course, there. And Florida's unemployment rate is 2.6%, which ranks 13. But here is the statement that was given at the conclusion of at the last FOMC meeting, that, you know, again, kind of reiterating that maximum employment and price stability 2% over the long run are our goals. And they did raise the target for the federal funds rate to 5 to 5.25%. Of course, they're always monitoring things. They're going to, the goal is to return inflation to 2% over time, over that average, tightening a monetary policy, which is the contractionary monetary policy. And then this is the part that I said is important, the lags, which monetary policy affects economic activity and inflation. So one of my colleagues uses the example of Goldilocks. So you don't want the economy running too hot, inflation. You don't want it running too cold, deflation, which is something, you know, we saw during the Great Depression. You want just right. And so that's the goal, the just right. And so you've got to think about those lags, and that it will take time for this policy to work its way through the economy. And the one thing that you don't want monetary policy to cause an economic issue. So you've got to keep that lag in mind, and any kind of financial developments that might arise. And in addition to this, also reducing treasury securities and agency debt and mortgage-backed securities. And, again, reiterating that commitment to returning inflation to the 2% objective. And so that's a policy statement and the press conference usually, there is a press conference after the FOMC meeting, and you'll see the statement being released as well. And so here is just kind of a history of the federal funds rate. When the pandemic began, the federal funds rate was lowered to essentially zero. And then in March of last year, began slowly rising to where it is today, which is around 5%, in that 5 to 5.25% range. As I mentioned, even though you may have learned in your economics class about open market operations, I believe there's a lot of textbooks still saying that is not the primary tool for monetary policy anymore, because we're in an era of what's called ample reserves. There's a lot of reserves. So the rate on reserve balances is our number one tool. And that is interest rate that's paid on funds that banks hold in their reserve balance accounts at the Federal Reserve. And because this is a risk-free option for them, it serves as a reservation rate. So it's the lowest rate at which banks would be willing to lend out their funds. And so the federal funds rate range does not fall below this interest rate. And because it's an administered rate, the Fed can steer the Fed funds rate by adjusting this rate on reserve balances. And it's the primary, as I mentioned, it's the primary tool that the Fed uses to adjust the Fed funds rate. So it's 5.15. Some of the other administered rates we have is the overnight reverse repurchase agreement facility, because not every financial institution can earn interest on the reserve balances. So we don't want that rate to fall below. So to provide support, the Fed offers this rate, the overnight, and I'm say it slowly, overnight reverse repurchase agreement facility, to a broader range of financial institutions, and they can earn this overnight rate, or ONRRP, by depositing funds with the Fed at this facility. And so that's the second one that sets a floor for the federal funds rate. I know I'm kind of getting into the technical stuff, but I wanted to mention this anyway. And then the discount rate, it's the rate charged by the Fed for loans that it makes through the discount window. Those are usually when financial institutions borrow from the Fed, it's usually overnight. They're likely not to borrow at a higher rate that they can borrow from the Fed. So because of that, it serves as a ceiling. It will serve as a ceiling. And so the Fed will adjust these three administered rates, usually by the same amount. It's going to be in the same direction. And then, of course, the open market operations, which was at one time the primary tool, no longer in the era of ample reserves, but that's the buying and selling of government securities. So if the Fed buys a security, it's going to pay for this by crediting the appropriate bank's reserve account at the Fed, and that way they change the level of reserves that's in the banking system. But it's these administered rates that are now the key tool for monetary policy. Now, as I mentioned, they're meeting tomorrow. I can't speculate on what's going to happen. And, but there is something, and this next meeting is going to be one where they put out something called the Summary of Economic Projections. And that's when they poll the members of the Board of Governors, plus the 12 Federal Reserve presidents, on where they see various economic indicators going this year and in the longer run. And so if you look at it here, their projections, if you look at real GDP, which is gross domestic product, where inflation is taken out, we see a small increase for 2023, 1.2 and 1.9 for 24 and 25. That's a projection, and about 1.8 for the longer run. Unemployment, the projection 4.5. Okay, and then and so we see at about holding at that same level, they see that's and I'm looking at the median here, holding at about the level it is now for the next couple of years. Inflation though is there is, and then we see, as I pointed on the graph, it went from around 9% last summer. We're now already down to 5%. Inflation continuing to lower and moderate, getting us closer and closer to that 2% goal. About 3.3 this year is the projection, and going down to right around the goal of 2025. And that's about the same for the core. The federal funds rate, you also see there that the projection is that it will also decline over the longer. And so that's so I can't predict, but I can give you this, and there's going to be a new updated version of this released with the press statement and the statement that's given after the meeting on when it concludes on Wednesday. And so that concludes my part, and now we're to the questions.
Awesome, Leslie. Thank you so much for that amazing conversation. I think, there's a lot about inflation and what are interest rates, and that's really why we wanted to get into this today, to kind of have a better conversation and understanding of, what is causing this, how is our government reacting to this? Because I think it's kind of, something that's in our peripheral sometimes that we hear on the news, but sometimes we don't really talk about. So first off, thank you for that amazing presentation. We do have some questions, both from the audience and so that I'm personally curious about. So the first question, and something you alluded to, is, long-term planning personally, retirement planning. And there's some concerns that, a lot of people probably won't be able to save up $1 million, but, what they can save up, how should they aim to protect those savings from, inflation? Should they change their retirement planning based on where they think inflation might, affect their retirement savings amounts?
Yes, and so I'm not a financial advisor, so I can't, say here's my financial advice. But it's something that you really need to factor in. I just think of the example of my parents. My parents have been retired for 26 years. So if you're looking at a fixed pension, and we know that Social Security is actually adjusted up, and it has had one of the largest increases ever recently, it is adjusted up. But if you're looking at a fixed pension in year 1 and year 26, it's because over time inflation gradually moves up, not going to have the same amount of purchasing power. And that's something to really think about. And it's something that concerns me because we did go for decades with almost no inflation at all. For many people in their lifetime, this is the first time they've ever had an experience with inflation. I'm old enough, I remember the late 70s, early 80s, and the double-digit inflation of that time. But people aren't factoring that in. when you think about you're earning, let's say you're earning 2% on your bank account and inflation is 5%, then you're losing 3%. You're not getting ahead. And of course, we know as a general rule, when it comes to financial investing, to get a higher return, you have to take more risk. And that's not always something that some people are prepared to do. Everyone has their own their own level of risk that they're comfortable with, but it is something to think about that it's not like, years ago when a period of retirement might be 10 years. Now you're looking at 20, 25, 30 years or more. And that's something you need to plan for.
Awesome. That's a great, and as we mentioned before in disclaimers and other webinars in the Money Matters series, Leslie and I, we're not your financial consultants. So, if you're interested in seeing, an effective retirement planning, please consult professionals. But Leslie, thank you for that really good insight. And kind of along those lines, as we make money, a lot of, and you mentioned this in your presentation, that a lot of the folks who use United Way services or are living in Tampa Bay, a lot of them live paycheck to paycheck. They really try to stretch every penny that they have. So how does inflation impact their salaries, if they're contractual, if they're making just a regular hourly wage? How does inflation really impact those families that are living paycheck to paycheck?
Well, they are the ones who are the most affected. And I'm just saying this anecdotally, what I've heard, some evidence that some people are taking on second and third jobs. There has been year over year, there has been some increase in wages. We know with the labor shortage, it's about 4%, although that is moderating. In fact, another resource I've mentioned a couple of times, the statements that are put out by the Fed after their policy meeting. But there's also a really great publication called the Beige Book. And the Beige Book gathers all of the anecdotal information that our research department will go out and meet with businesses, not only large businesses, small businesses across various different sectors, and gathers this anecdotal information. And that's really important because a lot of these data points and statistics come out monthly or quarterly. And very often, business people will see trends before they make it into the data. And in fact, that happened when wages first started to rise, where they were seeing businesses saying we're having a hard time finding workers and we're having to raise wages or benefits. And so they had it has a national statement, and then also for the 12 Federal Reserve districts, and gives that anecdotal information. And so that's really important. We kind of call monetary policy part art, part science. And so this anecdotal information is the art part when you're hearing these, and that is something that, hearing that people are taking on second and third jobs, hearing that, one of the things that I saw very early on when we saw the price of food elevating was people changing to generic foods. That was a trend that they were noticing. And so, but it does definitely hit low and moderate income households the most because they are living paycheck to paycheck.
And I think, that's really important. I based on that and everything you've been saying, Leslie, I think one of the biggest takeaways is how much data and input goes into, the Federal Reserve trying to figure this all out. It's not like they're just winging it there and saying, we're just going to raise interest rates this month. It's, it seems like they're getting lots of sources, both, this anecdotal information that you just mentioned, as well as all the information that they're getting collaboratively throughout the country. So I think it's really important for folks who are listening today to, to understand that there's a lot of stuff that goes into making these decisions, right?
That's right. And that's one of the things that, is something I always point out as well, is that there's monetary policy, which has a role, and then fiscal policy, which is tax and spending changes that are enacted by Congress and the president. And the monetary, when the federal funds rate is set, that is set for that's for the entire nation. And so that's why we get the input from all 12 Reserve Bank districts. And we're a monetary policy. That's one part. And then if you're looking at something that might be like, although it was many years ago, Hurricane Katrina. And a lot of people say, well, what is, the Fed and Hurricane Katrina? Well, that's a localized, local, regional, that where fiscal policy and providing support through fiscal policy would be better for something that was localized like that.
Oh, that's really interesting. So in your presentation, you had talked about the Fed's goal is 2% inflation. Is there a reason that it's not 0%? Is because inflation, as we talked about, it impacts, especially for those who are lower middle income families, that really impacts the cost of goods and services. So why can you explain more on why the goal is 2% and why the Fed is like, we're gonna get rid of all inflation, there's gonna be 0% inflation?
Yes, that's a good question, because that's something I always would have with my students. Why don't we want to have zero? Well, a little bit of inflation actually reflects a healthy economy. It reflects a economy that's growing. It reflects a strong demand for goods and services. So a little bit of inflation, that's a good thing. Again, it's that just right, and we don't want to have deflation as well, which is price level falling. And a lot of people, a lot of my students would say, that sounds great. Price level falling sounds great. And then I said, well, there's a price called the price of labor, wages. Your business and the price that you're getting for your goods and services is falling. That's not good. So you don't want to get into the negative. That's, of course, what we saw during the Great Depression. You want to get that just right. And 2% reflects a healthy economy, economy that's growing.
Okay. And then you talked about, deflation being a concern for businesses. As we're talking about, switching back to inflation, for businesses and industries, what are usually the first signs, what are the first impacted industries and businesses, and I think, Florida plays an interesting role because we have so many, the service industry is so big, our farming and agriculture industry. So can you talk more about, if looking from the lens of the Federal Reserve, are there kind of industries that you're looking for these red flags for when inflation starts becoming an issue?
Well, I think it's very individual to the industry, and that's a good point you put out about Florida tourism, and what happened during the pandemic when tourism dropped off. A lot of it goes back to the basics of supply and demand. You look at and I always want to make sure I emphasize this, that inflation is an economy-wide phenomena. It's increasing the price level, but you look at that basket of goods and we see that, that food is higher than the general CPI. You look at, restaurants or large institutions that have food services. And last summer when we had, and a lot of different factors play into food and gas. But you look at, transportation industries. I think it depends on the individual industries, and so that's why, even like we have that My CPI tool for individuals, different industries based on, what is the largest part of their costs are going to be affected differently. So I don't think there's really maybe one kind of thing, we watch the data, but I don't think there's one thing you can really point to, because it's going to depend on your individual industry.
Okay, that makes a lot of sense. I have a couple questions left, and then if anyone in the audience has any questions, make sure that you can use a Q&A feature in the Zoom webinar, so that way you can share your questions, and hopefully Leslie will be able to answer them. Hopefully be able to answer this next one, Leslie. I know we're really not supposed to predict what the Federal Reserve is going to talk about tomorrow or what they're going to do with interest rates. But looking toward pricing of goods and services in the future, but it seems like there was a point, an inflection point in COVID when everything started getting much more expensive. That's when we started. And so I think, a good question people might be wondering is, are we going to go back to the good old days before COVID, when eggs weren't so expensive? Will we ever be able to get to a point where those goods and services, the price of them actually goes down to what it is, or is this our new normal?
Well, in general, inflation does tend to be on an upward trajectory over time. And I think a lot of it went into it. So one thing I can say, and I can share this from the Beige Book, is, during the pandemic, you had a lot of spending on goods and services, and more. We had spending on goods and services, but a lot more goods, right? Because people are not traveling. People, we saw the lowering gas because there wasn't the demand for it, because people were staying at home and people were shifting to goods. Now we're starting to, and so, that's just supply and demand. There's a higher demand for goods. Prices are going, that's the law of demand. As prices, as quantity demanded, increases, price is going to rise. And then we now are seeing, and this is in the Beige Book, that people are shifting over to services. There's this pent-up demand of traveling. A lot of, you've probably heard relatives, friends, and family taking that first big family trip. Maybe some people took it last year. Florida's a little bit different from a lot of the rest of the country. A lot of people, are taking it this summer and getting back on the road. And so that's one thing I would say about that. It just, that's the best way I can answer that question, I think.
Okay. Another question is, as we're looking at, and a lot of this conversation has been about local and national inflation. How is inflation impacting us here in Tampa Bay and Florida, United States? But inflation is a global issue. So can you elaborate more on how, inflation is impacting countries differently? Because, there are other countries that have less inflation than us, and then others that have more. Can you elaborate more on that?
Sure. So that's a good question about why it differs. And last year, the Federal Reserve Bank of San Francisco put out a paper. And one of the things they said is a lot of it had to do with monetary and fiscal policies that differed among nations. We know that the fiscal response to the pandemic in the U.S. was very, very large. The support that was given by the government, the stimulus checks and so forth. In fact, the fiscal response to the pandemic was 4 times that of the financial crisis. So that's one thing. And the researchers from the Federal Reserve Bank of San Francisco pointed that out. Countries differ in their exchange rates, their interest rates. There was several years back, Christina and David Romer, this was a paper that was done several years back, but they also looked at this same question and said that a lot of it comes down to economic fundamentals. It comes down to how open an economy is, their political stability. Central bank independence is very important. So we're called the Federal Reserve. And but I don't work for the US government, which surprises a lot of people. So we say we're kind of quasi-governmental. So if you go to the Board of Governors website, it says federalreserve.gov. Though the Board of Governors, they are the government arm of the Federal Reserve. The 12 Federal Reserve banks are private institutions. And we are not supported by government funding. And that reason is because you want the Fed to be independent. Because as we've been discussing this entire webinar, people don't love it when interest rates go up. They don't love that, but that is the prescription for when you have inflation. And so you want to have that independence free of politics. And so the question then comes, well, you're not supported by the government. How are you supported? And so the Federal Reserve is self-funding. Most of the funding that we have comes from the interest that is paid on Treasury securities. And then the other part is from the fees that we charge financial institutions for our services. But one thing that's kind of been a rule is that when you have the more independent, and this has been studied across many, many countries, the more independent your central bank is, the more moderate inflation tends to be. And so that's why we want to preserve that independence and not be funded by the US government and keep the politics out of it.
Yeah, keeping that barrier seems like a really good idea. that looks like that's all the questions we have, Leslie. So, thank you on behalf of United Way, USF, and all of our participants for, joining us today. I think this was a really enlightening conversation just because, like I mentioned before, this is a lot of this stuff can go over my head. So it's good to have an expert from the field who is used to talking about this to tell us more about, what is actually happening out there. So Leslie, thank you so much.
Thank you, Matthew. Thanks for having me.
Awesome. And for those who are still with us, I encourage you to RSVP for our next Money Matters session. It's going to be on Monday, July 10th from at 12 p.m. to 1 p.m. It's going to be all virtual. And we're going to be joined by Truist Bank to talk about buying your first home. So this is going to include, how do you prepare to buy your first home, what to know, what to expect, all that fun stuff. So I hope I hope that I can see you there. If once you are done with the webinar today and you close out, you should be prompted with a survey. Please complete this satisfaction survey so we can better understand how to make sure that these webinars are as good as possible for you. So, thank you very much for joining us today. Make sure that you RSVP for upcoming Money Matters webinars and have a great rest of your week. Bye-bye.